Welcome to our channel, where we discuss trading strategies and techniques to help you become a successful trader. Today's topic is trading with chart patterns. We will be discussing various chart patterns that can help you identify potential trading opportunities in the market. There are several chart patterns that traders use to make trading decisions. These patterns can provide valuable insights into the direction of the market and the potential movements of prices. Today, we'll be discussing the following chart patterns: symmetrical triangle, ascending triangle, descending triangle, double top and bottom, bullish and bearish pennants, flag patterns, head and shoulders patterns, triple top and bottom, and wedges. But before I take you further, you will not be able to understand chart patterns if you have not watched the trendline class, so make sure you first watch it. Let's start with symmetrical triangles. This pattern is formed when the price of an asset is trading in a narrowing range, creating two converging trend lines. This pattern suggests that there is indecision in the market, and a breakout in either direction can occur. For symmetrical triangles, traders often enter a trade after the breakout above or below the trend line, with a stop loss below the trend line for long entry and above the trend line for short entry, and take profit level based on the height of the pattern. Another pattern is ascending triangle. This pattern is similar to the symmetrical triangle, but with one trend line being steeper than the other. This suggests that one side of the market is stronger than the other, and a breakout in that direction is more likely. For ascending triangles, traders can enter a trade after the breakout above with a stop loss below the trend line and a take profit level based on the height of the pattern. In trading, anything can happen, so it's important not to be biased. The name ascending triangle may have been given by some experts, but it won't always work. That's why we always place a stop loss. In this particular example, the price broke downwards. Descending triangles are formed when the price of an asset is trading in a narrowing range, with a horizontal support level and a downward sloping trend line. This pattern suggests that there is a bearish sentiment in the market, and a breakdown below the support level is expected. For descending triangles, traders can enter a trade after the breakdown below the support level, with a stop loss above the trend line and a take profit level based on the height of the pattern. This is an example where descending triangle broke upside, so always remember to place stop loss. Double tops and bottoms are reversal patterns that occur after an uptrend or downtrend. A double top occurs when the price reaches a resistance level twice and fails to break it, indicating that the trend is likely to reverse. A double bottom occurs when the price reaches a support level twice and bounces off it, indicating that the trend is likely to reverse. Double tops and bottoms. Traders can enter a trade after the confirmation of the reversal with a stop loss above or below the neckline and a take profit level based on the height of the pattern. Bullish and bearish pennants are continuation patterns that occur after a strong uptrend or downtrend. These patterns are characterized by a consolidation period, with the price trading in a narrowing range before breaking out in the direction of the previous trend. For bullish and bearish pennants, traders can enter a trade after the breakout above or below the pennant with a stop loss below or above the pennant and a take profit level based on the height of the pattern. Now here also you must remember that these are just some predictions that we are making for price direction. The only thing that separates you from being a better trader is stop loss. That is why always place your SL. Flag patterns are similar to pennants and occur after a strong uptrend or downtrend. This pattern is characterized by a consolidation period, with the price trading in a narrow range before breaking out in the direction of the previous trend. For flag patterns, traders can enter a trade after the breakout above or below the flag with a stop loss below or above the flag and a take profit level based on the height of the pattern. The head and shoulder formation is the best indication for a trend change. The head and shoulder reversal pattern forms at the end of an uptrend, and its completion marks a trend reversal. Thus, head and shoulders patterns are top reversal patterns. The pattern comprises of three peaks, with the middle peak, head, being the highest, and the two flanking peaks, shoulders, being lower and roughly equal. The reaction lows of each peak can be connected to form a support line, called the neckline. As its name implies, this pattern resembles the upper portion of a human torso and is made up of a left shoulder, a head, a right shoulder, and a neckline. Other parts playing a role in the pattern are volume, the breakout, price target, and support turned resistance. The left shoulder is formed after an extensive increase in price, usually supported by high volume. This is the first peak of the ongoing uptrend. After making this peak, the price dips slightly, usually on lower volume, to complete the formation of the shoulder. This dip is the start of the neckline, and the head is about to form. The head is formed with heavy volume on the rising side of the head and lower volume on the falling side. Prices then fall to somewhere near the same level as the low of the left shoulder. The right shoulder is formed by a rally in the price to a level roughly equal to that of the left shoulder. Again, it can be slightly higher or lower, but it must definitely be below the high achieved by the head. The decline from the peak of the right shoulder should then break the neckline. The neckline can be drawn by connecting both the lower points of left and right shoulders. The neckline can slope up, slope down, or even be horizontal. The slope of the neckline will affect the pattern's degree of bearishness. A downward slope is more bearish than an uptrend slope. One of the important habits you must develop is to learn to look at volumes accompanying the various chart patterns. You must always pay attention to this critical and important factor to avoid being fooled by the market and the price chart. In similar way, you can also trade inverse head and shoulder pattern. The triple top is a type of bearish chart used in technical analysis to predict the reversal of an asset's price movement. Consisting of 3 peaks. A triple high indicates that the asset can no longer rise and that prices may be lower. Triple charts can appear in all time periods. But for a pattern to be considered a triple chart, it must appear with an upward trend. The opposite of a 3 is a triple bottom, which indicates that the asset's price is no longer falling and could rise higher. A triple bottom is a bullish chart used in technical analysis, characterized by 3 equal lows followed by a break above the resistance level. Triple top and triple bottom chart patterns are based on the notion that 3 tops or 3 bottoms can be found almost at the same price level. The forecasting value is the greatest if there is a good symmetry between the peaks or the troughs, or the valleys. Ideally, the distance is the same from the middle peak to the peaks to both the left and right. A triple top chart formation is completed when the low, which is before the third peak, is broken on a close basis. If the third peak in a triple top formation is a false breakout, this is a strong indication of a trend change. The total distance between the peaks and valleys can be used as the initial profit target. In a wedge chart pattern, two trend lines converge. It means that the magnitude of price movement within the wedge pattern is decreasing. Wedges signal a pause in the current trend when you encounter this formation. It signals that forex traders are still deciding where to take the pair next. A falling wedge is a bullish chart pattern that takes place in an upward trend, and the lines slope down. A rising wedge is a bearish chart pattern that's found in a downward trend, and the lines slope up. Wedges can serve as either continuation or reversal patterns. A rising wedge is formed when the price consolidates between upward sloping support and resistance lines. Here, the slope of the support line is steeper than that of the resistance. This indicates that higher lows are being formed faster than higher highs. This leads to a wedge-like formation, which is exactly where the chart pattern gets its name from. With prices consolidating, we know that a big splash is coming. So we can expect a breakout to either the top or bottom dot if the rising wedge forms after an uptrend. It's usually a bearish reversal pattern. On the other hand, if it forms during a downtrend, it could signal a continuation of the down move. Either way, the important thing is that when you spot this forex trading chart pattern, you're ready with your entry orders. In this first example, a rising wedge formed at the end of an uptrend. Notice how price action is forming new highs, but at a much slower pace than when price makes higher lows. See how price broke down to the downside? That means there are more forex traders desperate to be short than be long. They pushed the price down to break the trend line, indicating that a downtrend may be in the cards, just like in the other forex trading chart patterns we discussed earlier. The price movement after the breakout is approximately the same magnitude as the height of the formation. Now let's take a look at another example of a rising wedge formation. Only this time it acts as a bearish continuation signal. As you can see, the price came from a downtrend before consolidating and sketching higher highs and even higher lows. In this case, the price broke to the downside and the downtrend continued. That's why it's called a continuation signal. See how the price made a nice move down that's the same height as the wedge. What did we learn so far about these Japanese candlestick chart patterns? A rising wedge formed after an uptrend. usually leads to a reversal downtrend, while a rising wedge formed during a downtrend typically results in a continuation opening parenthesis downtrend closing parenthesis. Simply put, a rising wedge leads to a downtrend, which means that it's a bearish chart pattern, just like the rising wedge. The falling wedge can either be a reversal or continuation signal. Is a reversal signal. It is formed at a bottom of a downtrend, indicating that an uptrend would come next. As a continuation signal, it is formed during an uptrend, implying that the upward price action would resume, unlike the rising wedge. The falling wedge is a bullish chart pattern in this example. The falling wedge serves as a reversal signal after a downtrend. The price made lower highs and low. Notice how the falling trend line connecting the highs is steeper than the trend line connecting the lows. Upon breaking above the top of the wedge, the pair made a nice move upwards that's approximately equal to the height of the formation. In this case, the price rally went a few more pips beyond that target. Let's take a look at an example where the falling wedge serves as a continuation signal like we mentioned earlier. When the falling wedge forms during an uptrend, it usually signals that the trend will resume later on. In this case, the price consolidated for a bit after a strong rally. This could mean that buyers simply paused to catch their breath and probably recruited more people to join the bull camp. It looks like the pair is revving up for a strong move. Which way would it go? See how the price broke to the top side and went on to climb higher? If we placed an entry order above that falling trend line connecting the pair's highs, we would have been able to jump in on the strong uptrend and caught some pips. A good upside target would be the height of the wedge formation. It's important to note that not all trades will be successful, and it's essential to have a plan in place for when trades don't go as expected. Traders should always have a stop loss in place to limit potential losses, and a take profit level to secure profits. Hope this video has provided valuable insights into trading with chart patterns and how to enter and exit trades based on these patterns. Remember to always do your own research and analysis before making any trades. Happy trading!